On behalf of Ventura Securities Limited, I welcome you all to UFO Moviez India Limited Q3 and 9 months FY24 earnings conference call. The company is represented by Mr. Rajesh Mishra, Executive Director and Group CEO, along with Mr. Ashish Madhuste, Chief Financial Officer of the company. I would now like to hand over the call to Mr. Mishra for opening remarks, post which we can start the question and answer session. Thank you, and over to you, sir.
Thank you, Vishal. Greetings, everyone, and thank you all for joining our Q3 and 9 months FY24 earnings call. The third quarter of FY24 marked the notable turnaround for our business, defying the initial challenges posed by the Cricket World Cup in the early part of the quarter. The business this quarter witnessed an upward momentum with the release of 502 movies, an increase from 484 in Q2 FY24. Despite a subdued start with movies like Mission Raniganj starring Akshay Kumar, Thank You for Coming starring Bhumi Pednekar, Bhagwan Kesari, Yariya 2, Ganpat and Tejas starring Kangana Rao, the momentum picked up significantly in the latter part of the quarter. Notable successes during the initial months included 12th Fail, Leo and Tiger 3, featuring Vikrant Masse, Vijay and Trisha and Salman Khan respectively. However, the real game changer came in December, witnessing a surge in successful releases like Animal, Sam Bahadur, Hai Nanna, Danki and Salar. This positive trend translated into our advertising revenue, recording an 83% year-on-year growth in in-cinema advertising, from Rs 186 million in Q3 FY23 to an impressive 341 million in Q3 FY24. Caravan's advertisement revenue also followed this positive trajectory, driven by impactful campaigns from the Ministry of Urban Development and clocked in a revenue of Rs 41 million in this quarter. As a result, Q3 FY24 emerges as a standout quarter in the current financial year, with EBITDA at Rs 184 million, a 4% Q1Q increase and an impressive 83% year-on-year increase. Looking at some key figures on the quarter and 9 months ended December 31, 2023. Our consolidated revenue for the quarter stood at Rs 1,184 million compared to Rs 871 million in Q2 FY24 and Rs 1,109 million in Q3 FY23. EBITDA margin for Q3 FY24 improved from 9.1% in Q3 FY23 to 15.58% in Q3 FY24. Profitability after tax continued its growth momentum this quarter, reaching 46 million compared to the loss of Rs 3 million in Q3 FY23 and a profit of Rs 33 million in Q2 FY24. Regarding the 9-month performance, the consolidated revenues amounted to Rs 2909 million as compared to Rs 3093 million in 9 months FY23. For the 9 months FY24 was at Rs 524 million, a substantial increase compared to Rs 224 million in 9 months FY23, 134% increase year-on-year. EBITDA margin in 9 months FY24 improved from 7.2% in 9 months FY23 to 18% in 9 months FY24. On the profitability after tax front, PAT for 9 months FY23 improved to Rs 103 million against a loss of Rs 120 million in 9 months FY23. The consolidated gross cash at the end of the quarter was Rs 882 million, with net cash standing at Rs 230 million after considering all outstanding debt. In terms of our advertisement screen network, it expanded to 3,407 screens as of December 31st, 2023, compared to 3,303 screens as of September 30th, 2023. This quarter witnessed a net increase of 104 advertisement screens with a notable boost in both prime screens and as well as popular screens. Also, post Q3 FY24, on January 3, 2024, we announced a tie-up with CSR Films, securing exclusive advertising screen rights across CSR's extensive screen network of over 403 screens. This collaboration has strengthened our presence in Gujarat and southern markets, especially in Tamil Nadu and Kerala, expanding our network to 3,808 screens nationwide. This reflects the growing confidence in the theatrical viewing experience. Looking forward to Q4 FY24. Added on a decent note with movies like Hanuman and Fighter. However, the upcoming lineup of movies, while subdued, yet is a decent lineup, including Teri Baaton Mein Aisa Uljha Gaya, starring Shahid Kapoor and Kriti Sanon, Mere Mehboob Mere Sanam, starring Vicky Kaushal, Lal Salam, starring Rajnikant, Article 370, starring Yami Gautam, Yodha, starring Siddharth Malhotra, Lapata Ladies, produced by Amir Khan, and Shaitan, starring Ajay Devgan and Madhavan, and The Crew, starring Kareena Kapoor and Diljit Dosanjh. So the lineup looks good, and we are looking forward, we remain optimistic to continue this positive momentum. Thank you. Over to you, Tushar. Hello.
Can I start the Q&A session, sir?
Yes, please.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. I repeat, ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Our first question comes from Aditya Karnath, an individual investor. Please go ahead. So please go ahead, sir. So there is no response from Aditya's line, sir. Shall we go to the next question?
Yeah.
Hi, can you hear me?
Yeah. If he manages to connect back, then we'll certainly take a question.
Mr. Aditya, please ask a question.
Yeah, sorry. Thanks for this. I think it's a good quarter. Just I had a couple of questions. One is your ad sharing percentage for this quarter is similar to last quarter, even though your ad revenues have gone up quite a lot. Your minimum guarantee actually has some operating leverage inside it, but that hasn't come through this quarter. So could you just share why your ad sharing percentage hasn't dropped to like 35-37%, even though your ad revenue has gone up? And second question is on margins. Just why the margins are lower in this quarter than last quarter, and what do you expect long-term margins to be?
Yeah, so your question relating to ad sharing is the first one. So let me take that first, because the others are not noted yet. Ad sharing percent, if you compare with previous year, it has fallen, but you are right. We need to also look at it on a QOQ basis. And on a QOQ basis, what you would see is that it is almost remained flat, but in Q1, it was at 48%. In Q2, it went down to around 41.5, and in Q3 also, it is almost at the same level, 41.5. The reason why from Q2 to Q3 you are not seeing any drop is primarily because as the cinema, large screen cinema viewing experience was well received by the audiences and started coming back to the theater. Even as you must have seen, even in our results, the theaters which were closed down slowly started opening, and better screens which were in the process of getting opened up, they have also started opening up. As a result, in the last 5-6 months, we were able to get hold of better screens. When I say better screens were near multiplex category or multiplex category, where your minimum guarantee commitments continue to be slightly higher than average. And what happens is when you have these screens getting added to your network, which is evident if you see 100 screens have got added in just one quarter. These screens, my obligation towards minimum guarantee starts from day one. But obviously my sales team takes some amount of time for them to get the kind of revenue from these screens. So you will always see some amount of gap there, lag rather. Sometimes it is 2 months, sometimes it is 3-4 months, but then that new screen comes back in the overall fold of the cinema network getting sold to the theatre. So that is one reason, and I'm so glad that you have identified this as a problem. But structurally, yes, you're right. As we progress from last year to this year, as the revenues went up, the sharing percent went down. And this is not the end of it. You're right. As the revenues would start going up, the sharing would start coming down. Except one caveat that I want to put is there's one major, very positive development that we announced this month about a partnership arrangement for advertisement sales of premium and key category screens down south with one of the players, TSR, a very strong player. Now, over there also similar situation would arise for next quarter, this quarter, that our obligation would start from day one, but for us to ramp up the revenue would take time. But structurally, yes, we should be able to see the kind of sharing which used to be there in pre-COVID, but slightly above that, so around 35 to 38% should be our sharing eventually. Sorry, I missed your second point. Can you please repeat your second point?
Yeah, sure. Thanks for that explanation. The second question is just on margin. This quarter's margin being lower than last quarter's margin. Is that seasonality what do you expect long-term margins to be?
So you're again right. It's a very valid point that the margins remain at the same level what it were in previous quarter, slightly lower than previous quarter. And the reason is simple. As you know that we had announced to the shareholders in our beginning of the year earnings call that we have actually moved our salary from fixed to variable, and 20% of the fixed salary was moved to variable because we are not sure how the performance is going to be of not the company but cinema viewing, whether it will be coming back with the same kind of proportion as that of the other industries. Fortunately, there is a turnaround, and fortunately, we all have gone back to pre-COVID levels when it comes to our cinema viewing habits, and therefore, all the cinema service providers or exhibitors are slowly reaping the benefit. So, the only thing that has moved is the provision that we have taken in this current quarter, which is to the tune of 5.7 crores for the variable pay, which part of it we have paid off, and towards the incentive for the sales teams. So that is one thing that has, 5.7 crores if you technically add back to the EBITDA, then you probably will be able to see the growth that is visible in the percentage sharing, in the EBITDA margin as well. So this 5.7 in other words is not purely of this quarter. The hit has been taken in this quarter, and some of it is a provision that we have built in, assuming that the current trend, positive trend, will continue even in Q4 going forward, because we don't want our employees to, in a way, suffer beyond a point when good days are returning. So please consider that 5.7 crores as one-time expense or an expense pertaining to previous quarters partly, and then you will, if you rework, you will get a better margin.
Got it. Thank you.
Thank you, sir. Next question comes from Ritesh Oswal, an individual investor. Please go ahead, sir.
Congratulations for good numbers. I think we have approx 100 crore plus cash and cash equivalent consolidated basis, and expected 60-70 crore net cash in next 12 months.
Before you proceed, I missed the first line. What did you say?
I think we have approximate 100 crore plus cash and cash equivalent.
Yes, sir.
Yeah, and 60 in next 12 months. So any thought on reducing balance sheet, pay off debts?
So if you actually see, our debts are slowly going down. In December 22, my gross debt was 83 crores. And December 23, my gross debt is 65 crores. So my debts are going down, and we are conscious of that. Fortunately, we were in a situation where we kept the cash and kept the debt, and that really helped us in that horrible period of COVID, because our revenues were zero for almost 6 quarters. But yes, after that, now that for last 3 quarters we are seeing profitability returning and even the normalcy returning amongst the cinema viewers. We have consciously moved ahead and started reducing the gross debt. What it means is that the debt gets reduced, but we don't really add more of debt from our side, because our business is such that for CAPEX, every year we do CAPEX, and for CAPEX we need debt. But this year we were conscious of CAPEX also, and some of the CAPEX we have done through our cash. So we are moving in that direction. But just to give you a comfort that while my opening remarks cover only the net debt probably, the gross debt is reduced by 18 crores. And yes, we are sitting on cash, but we will not be completely paying off the debt at this stage. Maybe we would still want to keep a buffer with us, which historically we have been doing. But that is not a huge buffer. You must have seen the way the management has treated the cash in the past ever since IPO. Whenever there was a cash accumulation, if there was no meaningful opportunity to deploy the cash in the form of acquisition or if deploying in business, we have time to time returned it to the investors. But at this stage, we'll continue with this trend where we are really consciously bringing the gross debt down, and cash is bound to go up because business is making money.
So next year CAPEX amount, appropriate CAPEX plan?
We should be going back to pre-COVID level, and that's again a healthy thing. This year we consciously thought of curtailing our CAPEX because that kind of demand was also not coming from the market. Next year we should be going close to pre-COVID CAPEX of 40-50 crores, but better clarity will emerge by the time we reach before we reach the next earning call, full year earning call. But you can take it that we'll be going close to pre-COVID level, at least 80%.
Okay. Thank you very much.
Thank you, sir. Next question comes from Aditya Sen from Robo Capital. Please go ahead.
Hi, thank you for the opportunity. Sir, do we have any updates on ad spendings by the government? Because that would be another major driver, that is the laggard that we are experiencing as of now. So any updates on this front?
So, on the central government front, ad spending, there has been certain uptake in that, but not to as great action as you would have felt happy about. So central governments, while they have done some activity, they still continue to remain on the lower side. As regards state government revenues, that we are pushing aggressively and trying to make up for the gap that has occurred due to central government spending going down across mediums. It's not only cinemas that they have gone up on, they have generally reduced their spend. I have mentioned in my earlier call this also.
Yes, right.
They have reduced their spend across print, television, everything. So it's a conscious call by them. But as I said, healthy point is that they have started some activity in this regard in this current year.
Yes, so on the data points, because since you have this question and which is very critical, two things. One is that this healthy performance that the company has put up in this quarter on the back of a good quarter, which was Q2. This is in spite of central government not really starting the spending. So, in a way, if there is a change there and the central government ministries start using cinema as a medium once again, then that is going to be a phenomenal positive for the company. Honestly, we don't know when. Nobody from industry would know that. But on the state government side, the data points are, last quarter we did 7.2 crores. This quarter we have done 8.8 crores, state government. So it's almost 21% growth. And on YOY basis, against the 8.8 crores of this quarter, in Q3 last year, we had done 4.4 crores. So it's almost double. So there is some healthy traction. Obviously, I'll put a cautious statement that when the elections gets announced, then all the state government ministries are required to stop their campaigns, and to that extent there will be some reduction from this particular segment, not overall segment. ESUs would still continue.
Okay, so this is a valuable information. Thank you for this part, especially the part that they'll reduce the expenses in the coming quarter. And so, given the fact that central government, everything is dependent on central government, I don't think we'll be able to cross the pre-COVID highs of 200 crores revenue from this advertisement. Am I right on this?
So, if you're having a time horizon of next 1 year, then answer is yes, we will not be able to cross. But the inherent strength of the medium is such that the only thing that was lacking was people coming back in cinema. Now that is really happening and that is continuing. All it is the mathematics of number of minutes sold and the spot rate. So if you have to really increase the revenue 4 times, I have to double both these parameters. Currently I am selling 5 minutes. Some of the better multiplexes manage to sell upwards of 20-25 minutes. Obviously I'm talking about 2x growth because my network is really large and it's a combination of different category screens. And the spot rate eventually plays out, which I don't need to say, as the demand increases and the scarcity is there, the rate goes up. So certainly, that is the biggest driver for us, the ability of this network to deliver on the same investment done in the network, with the ability of the network to deliver higher advertisement revenue. And that has been the draw all the time.
Okay.
But not in 1 year.
Not in India, that too we also foresee as of now.
Yeah.
Okay then. Thank you for your answer.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I repeat, ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Our next question comes from Rahul Vashishta from AXA Capital. Please go ahead, sir.
Hi, this is Rishi Maheshwari from AXA Capital. This is regarding your association with TSR. If you can highlight how have the contract been negotiated over there, what are the terms? As we understand, TSR itself is a digital chain for streaming ads. So what is our association with them? That's my first question. If you can please let us understand the commercial terms over there.
TSR, the association with TSR is a basic understanding of acquiring the advertising selling rights of their screens. The basic purpose of this was to increase our footprint in the southern markets, especially Tamil Nadu and Kerala, where they have a good presence. So we have added around 180 screens of TSR in Tamil Nadu itself, and Kerala another 54 screens, and Karnataka 36 screens. So it gives us a increased footprint in the south market, and this allows us to capture pan-India campaigns from even in the north. The way it is structured is we are acquired the advertising rights. I don't want to get into the actual sharing of the commercial terms over here because a lot of it is confidential also in nature. But basically, there is an amount agreed and we pay out according to that. The entire inventory of these screens is exclusively going to be marketed and sold by us, and that is the broad contours that I can share at this stage.
So, basically, just to add on to what Rajesh said, one, it is extremely was critical for us to have a better footprint in South, which we have achieved through this. But the way a financial investor can look at this particular deal is that this is an absolutely asset-light model where we are not going to incur any upfront capex, so to say, which we do in other screens. And in return, what we are getting is the ad rights of this good network, which we can sell as a composite network along with ours, which in turn is going to get medium to long term a lot of benefit. But one of the earlier question I was trying to answer about sharing, the nature of any arrangement, whether it is with a deal like TSR or an individual screen, is such that my liability starts from day one, and my ability to integrate that screen or that network in mine takes at least 2 to 3 months. So till that time, there's a short-term gap you will see where my revenue from that network or that theater is lower than my commitment. But basically, it's an asset-light model. I'm going to be paying a fixed fee, which is in the form of an MG, for acquiring those networks, and beyond that, the revenue gets added to my profitability with me not incurring any capex on this.
Sure, helpful. So, just to extend this, how many of these 400-odd screens will you place in the premium screens?
Quite a lot of them, because this is primarily a DCI network which is installed high-end equipment, and roughly 75% of the network I would place in the premium category.
Okay, thanks. My next question was to understand going forward any association that we can assume with Cube in any other form that the management envisages, or is that story done and dusted with?
I mean, I never say never do anything, but right now we have just come out of a potential association. So right now nothing is there on the radar or horizon. Something comes up, definitely we will be always open to something. But right now there's nothing.
What could be the cost associated in terms of the merger or the JV that was planned? Was there any cost that was built in 9 months FY24 PNL?
Okay, so you mean, just to understand your question better, you mean was there any cost incurred estimated for completing and operationalizing this JV? Is that the question?
That is right, absolutely.
Okay, so no, nothing apart from the
nominal legal fees and consultancy, nothing much.
Most of these costs got incurred in Q2, partly in Q3, and all of that was in relation to the legal fees and the advisory fees for putting the JV structure together and related activities. Not really significant. Beyond that, there was no cost. And that was not your envisaged.
There is no cost or there is no breakaway fee or anything from that. It was a mutually agreed dissociation. So there's no other cost incurred.
Sure. All right. Thank you so much. Okay.
Thank you.
Welcome.
Thank you, sir. The next question comes from Shivam Shah from SmartSync. Please go ahead.
Hi. Thank you for the opportunity. I have a couple of questions. The first is are we seeing any potential disruptions from any other, technology like cloud or internet? And the second would be there is from the Hollywood side, they have some sort of a JV, studios have come together and developed their own standards. So do we see any potential threats from that side? Like something of that sort happening here in India?
Not really, because as far as the films that are releasing in the cinemas are concerned, the Hollywood films are under VPF sunset as it is. So even right now there is very little impact on the VPF front for us. Advertising, whenever the films run in the cinema, we keep continuing to run. This is our agreement with the cinemas, so Hollywood really has no role to play in that perspective. So this consolidation at the studio levels doesn't really have much effect on our health at this stage.
And I assume one more point which you asked, and that is very, very critical, and that was about technology disruption. Just to quickly tell you that since we are a B2B kind of offering, on the face of it looks like UFO service offering. And therefore somebody may infer you are not really adopting to newer technologies, or you are offering what you were offering 18 years back. But that's not true. If you actually go in theater, you will find that as simple as the server, which used to be more in the form of a PC environment, now it is a handheld device. Okay. So what I'm trying to say is that unlike B2C, where Samsung, when it rolls out S8, S9, S15, S20, S24, we all know that okay, they are upgrading and they are not Nokia. But in B2B offering, it is difficult unless somebody spends time with us. It is difficult for us to explain. This is probably the forum where I can speak, and for investors to know whether this company is really doing upgrades and catching up with the technology changes or no. So we have done this technology catch-up both on the server front as well as on the projector front. And probably that's the reason why we are successful in last over 1.5 decades.
Okay, thank you. That answers the question. One last thing. How are we seeing the business as far as the caravan talkies is concerned? Can you please throw some light on that?
Yeah, so caravan talkies did decent business in Q3 and some business in Q4 also. In January we have been seeing. Right now the government is actively working on that, and there are some corporate clients also. And we hope to see business on this front going forward. I think state governments will adapt to it. The elections are coming up. They would be looking towards this. So we are pretty positive and hopeful on this front. Good thing is this business, it was shut down for almost 2-3 years, and there was no empanelment. Right now we have got empanelment on that, and business has also started flowing in. And central and state governments have seen the benefit and impact of this vans. We remain hopeful on this front.
Okay, sir. Thank you.
Thank you.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I repeat, ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Our next question comes from Krunal Shah and from Inam Investment. Please go ahead.
Hi, Ashish.
Hi, Krunal.
How are you?
Good.
Yeah. So just a couple of clarifications. So this TSR deal that we signed, so TSR I understand is a network like ours. So wouldn't it already have some advertising contracts in place and some advertising revenue that will be generating?
Yeah, so you're right. They are also digital integrators like UFO Moviez. They started in the south and they have a significant presence there. And
right.
However, they do have certain screens advertising on already booked with them, and the understanding is that these deals migrate to us, though not significant amount, but that is the understanding, because We pay them out from X date onwards, and anything pre-booked on those things will migrate to us.
Okay. So if I were to, sir, compare on a per-screen basis, say like our revenue, say YTD is 2.5 lakh advertising revenue per screen, where would they stand, in terms of percentage terms versus ours?
So in terms of actual revenue that they would have done up till now, they might not be stacking up as well as what we were doing, because we have a much more larger ad sale network, and even the screen network is much bigger. But the potential of things is higher, and that is where we felt the need to come together and tie up with this. And as Ashish mentioned to the earlier caller also, this is an asset-light model for us. We are not investing anything in the equipment already entirely invested in by TSR. The maintenance of that is everything by TSR on that front. So we just participate in the advertising rights over there, and that is the broad part of it. The potential is high on these things. I would not put the past track record as a benchmark for these things.
Okay, sir. Okay. And so just a clarification on the employee cost, 5.7 crore provision taken during the quarter. That would be for the last 3 quarters combined, sir, right?
Part of it is even for next quarter. Yeah.
Okay, part is for next quarter also.
Okay.
So entire FY24 is taken into account almost.
Not really. I think part of next year, as far as variable is taken, and as far as your advertisement sales incentive is concerned, it is still Q3.
Okay, got it. And just one more question. So we've seen good traction in the corporate advertisement revenue. Could you help me understand, what sectors, are using our platform majorly right now?
What is the question? Okay, you mean the industries that are spending on us? Okay, so
yes.
Probably from Q4 onwards, we used to give these details, which we got a feedback are very useful to the investors to gauge who was spending more. But I would broadly say that apart from pre-COVID scenario, we used to have this satellite TV. The television channels used to be one of the major spenders. That segment has gone down. Just to answer, I don't have that information ready with me, and from Q4 onwards, I will start including it also in our opening remarks, so everybody has a reference to it. But quickly to tell you which segment has not come back, that is one segment which has not come back. What is getting substituted partly, not fully, is with OTT. And that is a very interesting take because that is, can be viewed as a competitor for us, but they are trying to advertise on us. So they are recognizing that, we are a mutually exclusive kind of mediums for entertainment consumption. Apart from that, the rest of the segments, unfortunately, I don't have data right in front of me, but I'll pull it and give it to you. But my hunch is that apart from that one segment, the rest have come back. Maybe real estate is one segment which has not come back. When I say real estate, some of these campaigns that happen at a regional and local level, those have not really come back. But let me do this comparison and come back to you. I don't have a ready information now, apart from the television channels data.
Okay, got it. And so just one more thing, just in the industry, we hear that the rural demand is very soft. How have you seen ticket sales in your network of screens in the interiors?
Some part of your question I missed. Rural demand is picking up. How are we seeing?
No, rural demand has been soft. No, my question was rural demand has been soft. So just wanted to check, with you, how have you seen your ticket sales in your network for the movies in the last 6 months?
So we can indirectly draw an inference about ticket sales because except one segment which is impact, we don't really, as a business strategy, get into the even the revenues of either distributor or exhibitor directly. And exhibitor for sure, we don't really count as tickets for various reasons which we all know that they are not compatible. But two things. One is rural demand softening or getting better doesn't really directly impact us majorly because cinema as such in India is not a rural phenomenon. On the screens that if you see and if you map it with PIN codes, almost 90% plus, or 93% plus screens are not in rural areas. So I don't know whether the same kind of softening you're seeing in urban, I mean, as a overall phenomenon, but in cinema we are not seeing it happening. In fact, even if you say key multiplexes, which obviously cater to a different segment, ours will be more or less same geography, but not really rural, which is absolutely dependent on agriculture and stuff like that.
Right. So my question is more on tier 2, tier 3 kind of cities. So the inference I'm trying to draw was that, our advertisement revenue would also be to some extent correlated with the demand for ticket sales. And
which is true. And that we are not seeing dropping. I mean, it drops with, let us put it this way. If you have a good movie, pursued it, people just go and block tickets over weekend unless there is a negative mouth publicity happening on that movie, it will continue, which means people want to come out and spend. Okay? And vice versa, if there is no content, like for example, October, November or currently Jan, mid-Feb, the content is weak, that time you will not find, unless somebody is a diehard fan or somebody really wants to go out, people will not come out. But that cannot be an inference that it is a softening demand. It is more to do with the quality of content coming out. It could be both regional and Hindi. So while the footfall or the admits, as they say, is linked to the fate of a film, one definite trend that we are also seeing is the quality of cinemas, the multiplexes that are opening up in tier and tier 3 towns, and even at times in tier 4 levels, the smaller multiplexes are opening up. That is a very healthy and positive sign for the business because cinema viewership is there. That is where the latent demand is there. And
got it.
There is a definite growth in tier 2, tier 3 towns for these cinemas. So wherever cinemas closed down in the past also, newer multiplexes, newer screens are also opening up. The only major advantage for all of us in cinema industry is that the unique viewers of cinema, various estimates are there, but probably none of the estimates goes beyond 8 crores or 9 crores. So in a country with a population of 140 crores, obviously at least technically 30-40 crore people can afford to go to theaters, correct?
Right.
If they are not going, that is only and only because the availability of cinema screens around them is not there. So that is a major point, that there are only 8-9 crore unique viewers who are putting together, maybe 10-12 crores, putting together 90 to 120 crores of ticket sales.
Got it. And in terms of advertisement revenue, what kind of a sustainable growth rate that we expect over the longer term?
Sir, I would say we have just got out of a super major shock. And people will wonder why we keep referring to COVID, but for cinema industry it was probably a longish shock than others. Everybody else came back on track and saw super demand, pent-up demand, but nothing happened, especially in Hindi-speaking market for a long time. 3 quarters, good. Some of the beliefs that we had are getting vindicated, that cinema viewing cannot be substituted by small screen viewing, either handheld or television. Movies will not directly go on OTT was the second belief that we had, but our belief remained with us till such time it was validated. Third belief, which is now getting validated, is if the people go back to cinema viewing, cinema is a wonderful and a very effective medium for advertisers to carry their messaging forward in the form of an impact medium. So that is also getting validated. Fourth, we wanted to validate whether if central government really doesn't support this in cinema advertisement, whether we will be able to push the second engine of corporate and still be able to continue the growth. That is also happening. So what we are doing is we are really not living by the day, but more like trying to look at it quarter by quarter and picking up the positive sentiments going around. So a little early for giving projections and estimates.
Got it. Thank you. Thank you, Ashish. Thank you, Rajesh. Thank you so much.
Thank you.
Thank you, sir. There is a follow-up question from Aditya Karan, an individual investor. Please go ahead.
Hi, thanks again. Maybe just a couple of follow-ups. Your kind of key metric, one of them is this number of minutes sold per show per screen. So this is almost recovered to your 2019 levels, right? So you have about 5.3 minutes versus 5.5 in 2019. Can you explain what drives this metric, and do you think that this is the peak saturation level of this metric, or similar to revenues, we should not expect this to exceed 2019 levels, this 5.5 minutes sold, or do you see this kind of increasing going forward, and why would it do that if so?
So I think
and then maybe a second, go ahead.
Yeah, addressing it in one of the previous questions where we were trying to estimate what is the possibility of this network to deliver. And answer is no, this is not correct that it cannot go beyond 5.3. The better networks deliver more than 18-20 minutes average. And that is known to all of us. We go and see movies in those theaters and we see advertisements. So certainly that is one of the major, kind of an opportunity for us. And consequently, the revenues should keep going up. And the only thing that can be questioned is once we reach a stage of say 10-12 minutes, then there will be questions around what kind of growth we are seeing. But currently we're really away from reaching a saturation point, in our belief.
Okay, so 2019 was not peak. It was just COVID happened and therefore you saw it down.
Yeah, because see, you have to have only one answer for yourself. What number of minutes you think this network can sell? If say a premium multiplex sells average 20 minutes, what would this network sell? 20 minutes, 18 minutes, 15 minutes? That would be an upper cap in your mind for the revenue. And the spot rate is something which we'll all have to wait and see how it plays out.
Yeah, I mean, the question is actually that if central government revenue doesn't come back, which seems like it may be, they will not spend 1,000 crores like earlier. What is your kind of network capacity to sell ads? I think that's the question.
So slowly we wanted to, for a long time we wanted to disengage from dependency on central government. Unfortunately, we were pushed in this situation a little early. But more important question is whether, I'll repeat, whether from 5 minutes inventory of 10-12 minutes first can be sold, can be consumed in those screens. And if that can be consumed there, obviously, I don't think that there is dearth of advertisers who would want to spend there. If actually this medium is positioned and proven, which was the case pre-COVID, we were almost there.
Okay, got it. And then just last question, ad prices, again, they've been trending up nicely this quarter as well, but it's below the 2019 peak. Just can you explain how the industry looks at this? Is that ad pricing at peak levels? Will it exceed 2019 levels? Just some industry context on what's happening maybe with Cube and how do you compare with that? And then second on that is TSR's ad pricing per minute higher than yours, or are they lower quality than yours?
So the spot rate is one area where we have chosen to not get into discussion on open calls because that really hurts the business, because the medium is such that varied rates get offered to various customers. And probably that's the reason why everything else is there absolutely transparently from our side except the spot rate, which could be derived. But we don't put it and we don't really discuss it. So we would choose to continue with that. But generally our network currently is getting sold lower than premium multiplexes for obvious reasons, and that kind of a gap would stay. But that would get bridged to some extent, but there will be a gap between the pricing of ours and pricing of premium multiplexes.
Okay, thank you.
Thank you.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Next question comes from Jay Sundalia, an individual investor. Please go ahead. Please go ahead, sir. There's no response from Jay. Shall we move on to the next question, sir?
Yes, please. Yeah, sure.
Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I repeat, ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. There are no further questions. I now hand over the floor to Mr. Tushar for closing comments.
Thank you. On behalf of Ventura Securities Limited, we would like to thank the management of UFO Moviez and the participants.